Alright everybody, it is Monday, November 6th, 2023, and I had some questions. So I've had these questions in the past and I want to clear some stuff up about our automated trading system. So you come to our website, it's precisealgorithmtrading.com, and when you go to our web or to our home page, you get this nifty little home screen that opens up like this, and then it gets to a static page that looks like this. And when we roll down here, we have sample equity curves. This is what our sample systems were doing at the time when they were taken, which that's 1/6 of 23. So that's what it looked like back then. These things move through. So this was the NQ system. For that period of time, and this is the Russell system for that period of time from 7/3 of 22 to 12/30 of 22. So you can see that there. And then you go down here, and these are examples with videos, and you can see actually how the price moves while it's in a trade. And it's helpful to understand the platform. The platform being TradeStation. And then down here is where we actually have the performance reports, all the statistics to go with it. So let's look at the Russell performance report for a small account, and so it gives the total gains. This happens to be 16,353, and again, that was from this period of time. So these things change daily, and it gives a profit factor if you're into that. We've got this stuff built, so you don't have to really concern yourself with it, although it helps to kind of understand how all that works. But the big thing is this is max shares and contracts held, and that's one. So there's one contract. So with this system, you have to be able to afford, your account has to be able to afford one contract, and you have to be able to handle a max drawdown, actually more than this number. I think they actually tell you in TradeStation, they say like account size required. There it is, this number here. Well, we don't agree with that here at all. You have to have your largest drawdown, which is this, times 3 or 4. 4 is more conservative, and if you go 4 times this, you should never go wrong, because our max drawdown here is $4,000. And if you look at it in the context of the equity curve, I mean, this is a big drawdown right here, and you'll have these. You need to be able to afford to have those, and that's why when we actually put it on here, we're saying 4 times that drawdown. So that you need to be able to have that, which means in this case you would need to have something in the neighborhood of $16,000 to $20,000 to be able to trade. Your account would have to be that big for you to be able to endure the drawdowns. So I hope that helps. That's a big deal when it comes to automated trading systems. It's really a big deal when it comes to trading, period. There are plenty of ways to have smaller accounts than that. That's why I show the other stuff that we go through. So you can actually trade with options, and you can trade a much smaller account than that, but you have to be willing to put on like 100% risk and be able to trade like $100 and lose $100, and or $100 and lose $50 if you want to set hard stops, and we can get into some of those things. So I wanted to show that. Some other things we have here, there's also trade analysis, which this gets into a lot of stuff that frankly I don't even look at. But the trades list is something that I think is actually handy, that I look at every day. which is what I show on the website. This is every trade for that whole period of time, and since it moves, that's why I always look at the ones that are like this is from uh, 8/26/22 through 8/31/22. So that's, I mean, a while back now, but that's why I show them on the site. I'm going to get into it right now. So let's go here and look at our daily review for the way we trade our model portfolio. And so this is the YM contract from May of 23 until today. And literally these equity peaks are peaks in your equity. So this is the net result of wins and losses in this period of time. So on the weekends I show a much longer period of time so you can see how this thing actually rides and draws up and draws down. And then so this is the Dow contract, the YM, for today. So there were 3 trades today, 1 winner and 2 losers, and they're all about the same as far as, $400 a piece. So net down, about 400 bucks. And that's the way trading is. What you do is you add all this up in time and you get an equity curve that looks like this. And you add up a much larger sample size and you get an equity curve that goes from the bottom left to the upper right, which is really what we're after here. So then we go on to the Russell, and this contract has this system hasn't traded since the 2nd, and it only traded once on the 2nd, so it hasn't traded for a couple days. And then the NASDAQ is the one that's obviously gets up and going a little bit more. It's nice though, sometimes these things offset themselves. So when the NASDAQ has a bad day, the Dow might have a good day, or maybe the Dow and the NASDAQ both have a bad day, and the Russell has a good day. So, and sometimes they all have a bad day or a good day at the same time. It's just markets, but they're not built exactly the same way. They're built differently, and the whole thing is to try to reduce this drawdown while having an equity curve that goes from lower left to the upper right. So this is May until November, May until today, and in the NQ, and we've got a drawdown that's been happening here for the last few days. It's not straight down, it's got some bumps back up again. Sorry about that. And then we look here, these are the trades for today, and this one trades quite a bit, so it's one of the drawbacks of this system. I don't like how much it trades, but it's only 3 contracts. So I was trading 5 contracts with a similar equity, with a similar system, but this one actually has better results. So, and the fact that it trades more with fewer contracts is offsetting pretty much. So this is today's trading, and you can see it's mostly down. We had this big one right here in the middle. We've had some decent wins along the way, but ultimately we had a down day in the markets today, which is what it is. It's, you add them together and you get an equity curve that looks just better. And these drawdowns, again, to be able to stomach that drawdown, that is a whatever, 35 or 40, $35,000 drawdown. So if you traded 1 contract, you'd have to be able to stomach, the $12,000 drawdown, and you'd have to be able to do that. That's why we say 3 to 4 times bigger than that, so you don't never run into that problem. Does it mean you have cash sitting on the sidelines? It does, but it's there for when your system needs it. So that's how that works. I hope that helps. Let's jump in and look at the rest of the markets. So we have this is the ES, the S&P 500, the daily in the middle, the hourly on the right, the weekly on the left, and this has the overnight action that's going on. And you can see it was actually big and up in gray, but all above the average true range, the ATR trailing stop, which we're above that over here too. We got a nice big move. Usually after a breakout of the ATR trailing stop, you'll get maybe a day or two or three, and you'll get a pullback or at least sideways action until these moving averages catch up. And in a lot of cases, like what I'm expecting, is basically to pull back to about 50% of this range, which will put on I mean, it'll break the ATR stop on the hourly chart, but it'll hold on the daily, and then you can either wait until you get an ATR break back up above to get in if you're going to do that, or you could just, you know, hold your nose and buy when you're back down here in this area. And it might be a little cleaner to look at it with the S&P. I've actually got 50% lines drawn on here to where I'd expect the price to come to, and at this point I think there probably needs another one right here in the middle, which looks like where we got this gap would be an interesting place for the market to come down through. Now, can it continue to go straight up? It can, and I would expect it to hit its bump into this upper Bollinger Band and maybe hit some resistance, but it'd probably be a little healthier if we actually pulled back first, took a breath, and then we could rise up out of here. We've got green, green, and green going on the daily. We got green that's extended on the hourly, and then the weekly is all red. So a pullback into that zone over here would probably be helpful on the weekly, because we got pretty extended to the downside on the weekly. It'd be nice if we could go sideways to up for a little bit and get ourselves out of this. I mean, technically that's a longer term bearish signal, but that's not what we're playing. We're playing the shorter term. So as of right now, I'm actually relatively bearish going into Tuesday and looking for a reason to get bullish into the rest of the week and next week and the following. So that's the S&P. The Dow, it's a very similar story, looking for really either probably a move back down to the downside. We might get a bump up here into the upper Bollinger Band. That would be, and maybe a shooting star or something like that. That would be a telling signal. The Russell is kind of already doing this pullback that I'm talking about. So that's actually, it's already broken its trailing stop up here, and I would be looking for a move in the middle here somewhere. And let's look at IWM, because that would be the tradable instrument for the Russell, which is why I have these alerts in here. So the price gets down here, I'm going to be looking for reasons to get long and set my risk parameters, my stops, and my targets. All right. Last but not least, the Nasdaq, which has been the strongest lately. Although the Dow looks pretty strong compared to this. Same thing. Looking for the Nasdaq to roll over momentarily. And again, we've had some breaks here that didn't work out. So one of these times we're going to get a break, and I'm calling it now that this one is going to work out, and we're going to be able to unwind. Even if this comes up into this I'm back over here on the weekly, comes up into this ATR trailing stop and then rolls over, that'll be a much longer term issue, to where we got a wave 1 down, wave 2 up, unless this is wave 1 down there, wave 2 up, and then wave 3 could all come way down. Kind of hoping for the sake of the market that doesn't happen, but if that does happen, I'm looking into next year for it. So and again, I don't trade off of the weekly. I just use it as a understanding kind of where the market might go. The transports have broken up higher, and they look like they probably are getting extended as well, although this stuff could all just continue to take off to the upside in case there's too much shorts going on down here, and they'll just continue to take the shorts to the woodshed if that's the case. It's why in this case, right now, it's my position is more bullish than bearish, but we've got plenty of bearishness on to take advantage of this short-term potential. And what did oil do today? More downward pressure in the oil market, more red candles. Gray went back to red, so this was a very tradable move. I took advantage of the first leg of it, but I did not on the second. So what's the USO look like over here? Yeah, this has been a little bit, they're decoupled a little bit between the USO and the CL, so this has been a little bit difficult, more difficult of a move. So, yeah, whatever. We're actually on the weekly over here. I'm going to be watching for, what's the monthly look like? Let's flip that up just for fun. The monthly's looking pretty bullish on oil, so what's this? Oh, unless you flip over there. That's why I say they're a little bit decoupled right now. Which, lower prices in oil probably means lower prices at the pump, so there's nothing too bad about that. All right, that's enough for that tonight. Let's go back to stockcharts.com. We do this every night. The bullish percent indexes. We're not affiliated with stockcharts.com. It's just a handy service. And we can see basically, well, this is a measure of bullishness in the markets. So you can obviously take the inverse and say that it's also a measure of bearishness. So 53.33% of the stocks in the Dow Jones Industrial Index, which is 30 of them, 53.33% of them are in a point and figure buy signal. So it's about 50-50, and that's what you get out of that. The NYA up today by 1.12%. The transports in a column of X's and did not move today. The NASDAQ flipped over to a new column of X's today. It's a big deal, at least momentarily, so that's showing potential for the rising prices that I was talking about, even though we might roll over for a little bit, not on this chart, but in the actual price charts, like I've been talking about, and setting up for a larger move to the upside, potentially. There are no guarantees in this. This thing could just roll right back over to into a column of O's, and it's done that in the past. The S&P tacked on a new X today, went up by 1.84%, and it's on a point and figure buy signal. The OEX, which is the S&P 100 stocks instead of 500, didn't move today. And the NDX, the NASDAQ 100. So we are now on a point and figure buy signal on the NASDAQ 100. So this column of X's exceeded the previous column of X's to the upside, and that is what a point and figure buy signal looks like. So that's what I got for tonight. I hope that helps some of that explanation. I can do more of that if you guys want to drop a note. It is, I think a lot of this stuff is self-explanatory, but sometimes it needs to be explained better. So I can do that for you. And yeah, that's it. So I'll talk to you guys later. Have a great night. Take care.